Welcome to GRE. I'm your host, Keith Weinhold. Is higher inflation or even hyperinflation now in our future? And is an imminent recession, or even worse, a depression lurking? What's it all mean for your investments and your real estate? We'll investigate exactly what happens to real estate during recessions historically today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Hartsdale, New York to Springdale, Utah, and across 188 nations worldwide. I'm Keith Weinhold. I think you know that by now. You are inside one of America's longest running and most listened to real estate investing shows. This is Get Rich Education. Most people have two plans. Plan A, get rich. If that doesn't work out, the alternative is Plan B, which is hate rich people. We are firmly rooted in Plan A for you here. So yes, we're about building your wealth, but ultimately we are a lifestyle improvement show. I'm going to get to high inflation and the potential for a recession or depression in just a minute, but I recently got a reminder on the fragility of life and its finite nature. My oldest friend recently died. He was almost like a mentor to me. A friend of mine's grandmother recently died, shattering her world. And it's a reminder that you won't be remembered for the money that you make. You won't even be remembered. The real estate portfolio that you build, that surely won't last. The tenants that you serve, they'll die as well. I will be forgotten. This show will be forgotten. The people that love you, their opinions will die with them. Your haters, their opinions will die with them. You can confirm that this is true right now by naming your 8 great-grandparents for me. There, go ahead. You can't do it? I can't either. So what can you do, at least in this finite life that you have on Earth? What you can do is enjoy your existence. The good news is because you can control this. You can control enjoying your life and existence. As Get Rich Education is ultimately a lifestyle improvement show, and we are squarely helping you do that right here. And one way that I've done that over the years is by pointing out how inflation is actually advantageous to real estate investors. Well, it impoverishes most people. You're initiated on that by now. That's something that you really found out tangibly back during the pandemic. Now, today, though, wow, people are frightened. I've got some contemporaneous material to share with you today, but I'll give you some lessons so that even if you're listening to this 10 years from now, you're going to learn some lessons. Americans' inflation expectations for the next 5 years, they just hit the highest level since 1993. Yeah, expecting a lot of inflation. Tariff pressures are a huge concern. Now, last week, inside our newsletter, I sent you something that gave you some perspective on inflation. I sent you a photo of a Taco Bell receipt from 1999 that might have left your mouth agape. If you didn't see it, I'll tell you about it here and expand on this. And yes, it could leave you aghast, stupefied, gobsmacked, or even flabbergasted. In a sense, 1999 was not that long ago. It's sure not like ancient history. I mean, I was alive then. Yes, I am here and I'm from the 1900s. Well, this 1999 Taco Bell receipt that someone found perfectly preserved in the pages of a book, it shows a complete meal that was purchased for $3.50. It was actually just $3.26, and then the rest was tax added in. That's $3.50 for a chili cheese burrito, a taco, nachos, and a 16-ounce Pepsi. That's not the price for each item. That is the combined total from 1999. Well, all right, how much do you think those same items would cost today? I don't eat there. I went to the Taco Bell website and found out. I mean, what an inflation measuring stick this is. What cost $3.50 at Taco Bell in 1999 costs $11.44 today. I used the same sales tax rate to come up with that. So today it's $11.44. And today they also ask you a question at Taco Bell if you want to round up for the kids or something like that. And then just watch. Pretty soon they're going to request a tip too. That's a 327% price increase. And few people's wages have risen that much since 1999. See, I told you that you would be left slack-jawed and flabbergasted. All right, so let's look at where we are today. Now, it's not an apples-to-apples comparison, but, Taco Bell is a fast food restaurant. Let's look at the price of a consumer item at a sports stadium today. All right, because both are places that everyday Americans frequent. College basketball's March Madness tournaments have been taking place the last few weeks. Well, for the first time ever, the SEC is selling beer at its tournament. The price for one large premium draft beer is $17.50. So before tax or tip, $17.50 for one beer. All in, that might be $20 or more. And I doubt that the beer is really that premium. I mean, you know what kind of beer you get at stadiums. So we look at inflation. One beer today is at least 5 times the cost of a complete Taco Bell meal in 1999. That's price inflation. And that's the stuff that's highly perceptible. Okay, you've been seeing that effect all of your life. It's making most people poorer. It's making real estate investors wealthier. And then there's the inflation that few people consider, the less perceptible stuff, service inflation. And what are some examples of service inflation? Growing up, the Postal Service delivered mail right to my parents' porch. And they still do deliver mail right to my parents' porch. Their neighborhood was built more than 100 years ago. But look, when new neighborhoods are built today, like places I've lived and perhaps where you live now, the Postal Service doesn't deliver your mail right to the individual mailbox on your porch. Today, you've got to walk both ways to your neighborhood's mailbox cluster. Some people even have to drive to get their mail. So your mail is no longer being delivered, really. You have to go pick it up. Well, they don't lower the price for that reduced service level. That's service inflation. A second example is more obvious: grocery self-checkout. You're taking the time and doing the work of scanning your groceries, but yet they sure aren't lowering the prices of your lettuce and your beef jerky. And look, service inflation is here to stay. That is because companies make investments in it. The Postal Service bought those mailbox clusters. The supermarket bought those self-checkout kiosks. All right, so with this rampant price inflation and service inflation along with it, and the other forms of inflation that I've talked about on the show before, like stagflation, tipflation, shrinkflation, and skimpflation. What is an individual investor like you supposed to do? Well, stock and mutual fund investors get killed by inflation. I mean, think about it this way, just killed. If the S&P 500 gains 10%, but there's 5% inflation, that's a 50% hidden tax on your gain, plus you might pay capital gains tax on top of that. Savers really get obliterated. I mean, just destroyed. If your bond yield or your savings account pays 4% interest and there's 5% inflation, that is a 125% hidden tax on your gain. And then you might pay regular tax on top of that. So stocks and mutual funds and savings accounts are not the answer. What is the answer? Real estate and borrowing, the opposite of saving. And let me address now, whenever people get fearful that another wave of inflation is coming, whether that's tariff-induced or otherwise, let's not get carried away and think that hyperinflation is right around the corner. Although definitions of hyperinflation vary, the most accepted one by economists is a 50% inflation rate per month, not annually, per month. So that would be over 600% a year with compounding. I mean, that would be really hard to get. But what we do know is that inflation is still elevated above the Fed's 2% target. It's 2.8% today. And what we do know is that more inflation is coming. At what rate, nobody knows. These facts almost necessitate that you have either got to start your own business, which is tough, or become a real estate investor, which is easier, in order to escape this and acquire some lasting wealth. Any devoted listener here knows that the formula for beating it is luckily not highly sophisticated, not esoteric, not anything that you need a degree or certification for. Just own income properties with loans, and that's when inflation produces 3 profit centers. As we know, that is something that I coined as the inflation triple crown. So if you're new, you're learning something. If you've been around here for a while, here's a little comprehension test for you. What are the 3 crowns in the inflation triple crown? You win with asset price inflation, debt debasement, and cash flow enhancement. Asset price inflation benefits you because you have leverage gains. Debt debasement passively lightens our debt burden for us. And then cash flow enhancement, that boosts our cash flow above the inflation rate because our principal and interest payment stays fixed. And you can learn more about that totally free. You don't even have to leave your email address or anything. You can watch the 3 videos of the Inflation Triple Crown at getricheducation.com/ITC for Inflation Triple Crown. It's just good free learning for you there. I've made available at getricheducation.com/ITC. It is a foundational financial education. Is a recession or even a depression imminent? That's straight ahead. I'm Keith Weinhold. You're listening to Get Rich Education. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866. Hey, you can get your mortgage loans at the same place where I get mine, at Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is Freedom Family Investments co-founder Danny Lynn Robinson. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold, and you are inside episode 547. I'll tell you, being a landlord or real estate investor can really change you. Now, I was using the stair climber at the gym just before talking to you today. I like to set up a big fan down on the floor to keep me cool before running or climbing. Plug it in, set up a fan. When I'm done, I turn off the fan. It's just a habit. I don't pay the electricity bill at my gym, but it's just the way that I would want to be treated. But you know what? When I find a fan that's already set up before I grab it and start on the treadmill, that fan is always running when no one is using it. No one turns off their fans when they don't have to pay for the electricity. And this reminds me of when I owned apartment buildings in Anchorage, Alaska, and tenants kept their windows open even during the frigid winter so that they could get fresh air. Yeah, you can guess who was paying the heating bill. It wasn't the tenant, it was me. The larger the apartment building is, the more likely that the owner is the one that pays for more of the utilities. And of course, in that case, you can look into utility sub-metering. That process can be costly, but it might be worth it. It can increase your cash flow and your net operating income, which when it increases your net operating income, that means that it also increases the apartment building's value. And you know, in real estate today, you've got to look for where the opportunities are. There are opportunities in every market. Today, 4 places where there are specifically good opportunities are apartment buildings, where their values have fallen 20 to 30% in some markets. It's wise to invest in beaten down sectors that you just know are going to come back. Like, you know, the demand for apartment buildings is going to be there long term. This doesn't mean that you want to invest in any beaten down sector like office real estate. In general, I don't see how that's coming back. A second strong real estate opportunity today is to find overbuilt pockets, especially ones that exist in Texas and Florida. I mean, this is why they call them buyer's markets. A Texas or Florida seller might make you a deal. And that doesn't mean everywhere in these states. For example, Southwest Florida is one area that's specifically overbuilt, even amidst a national landscape that's underbuilt. A third and a fourth area of specific real estate opportunity today are 2 that I have mentioned before, but they persist. That is still brand new properties where many builders are still motivated to buy down your mortgage rate to about 5%, even 4.75% in some cases. And new builds have low insurance premiums too. And then a fourth opportunity, that's something that we've covered a good bit here these past few weeks. BRRRR real estate investing. Buy, rehab, rent, refinance, and repeat. That's a specifically good strategy if you don't have, say, hundreds of thousands of dollars in liquidity to invest. Now, you might ask, do those 4 strategies have validity? Do they have cogency in today's market where there are these fears of an economic slowdown? Oh, yes, they do, or I would not have gone over them. But these palpable recession fears are growing, and some are even asking, is a new Great Depression imminent? There is tons of bad economic news right now, not just in the US, but the global economy is on the edge. Starting earlier this month, stock market tremors have turned into full-blown convulsions. Trillions of dollars in wealth have just vaporized, wiped out. Investors are rattled, consumers are anxious, business owners are confused, and those in power in the administration, they insist that tariffs and policy swings are all just part of a transition period. But a transition to what? Some have even asked, is the everything bubble finally about to pop? Is this the brink of a recession or something even deeper, a depression? Well, one thing is undeniable. From stocks to crypto, asset prices recently made a free fall. And I've got some long-term lessons for you today, even if you're listening to this years from now, including what a phenomenon like this historically means for the real estate market. It's about what really happens to property values during an economic recession. Stocks recently had their worst week since 2023, barreling toward an all-out bear market crash. A bear market means when 20% of the value has been lost from a recent high. Even Bitcoin, the poster child of speculative excess, has cratered. The carnage has been everywhere. But yet, instead of taking steps to prevent an economic meltdown, the administration in power, whether you like them or not, they have introduced more and more radical policies that could accelerate the crisis. Now, some of the tariffs could help long-term, but the short-term pain is perceptible, and you've got to be able to survive it. We've got new tariffs on multiple countries, and these are our biggest trading partners. Even if these import taxes diminish, this is already strained friendships long-term, especially with Canada. These countries keep retaliating with tariffs of their own. Canada, Mexico, China, and the EU. Government spending is being slashed. Mass layoffs of federal employees have been underway for a while now. This is not just an economic experiment. I mean, this is a high-stakes gamble with global consequences. So is this a detox period, or is it an economic freefall? Treasury Secretary Scott Bessent described this economic shift as a necessary detox period. That's the phrase that he used. And yes, I need to acknowledge there is no more Grandma Yellen running the Treasury. For longtime listeners, that is a reference to the long-running joke about how my late grandmother resembled former Fed chief and former Treasury Secretary Janet Yellen. But anyway, according to Bessent, the U.S. must break free from what he calls its addiction to government spending and return to private sector growth. Now, hey, to me, that sounds good, actually. That sounds like a good plan for the long term. But here's the problem. That addiction has been the lifeblood of the U.S. economy for decades. And, this is something that regular GRE guest, macroeconomist Richard Duncan, has talked about when he's here. Remember what he's told us for over a decade here on the show? If the U.S. doesn't have 2% real credit growth, credit expansion, well, then we go into a recession. Well, what happens when the government cuts spending during soaring consumer prices due to trade wars? What happens when businesses hesitate to invest in the face of extreme uncertainty? Well, the bad news is that tariff whiplash and massive layoffs mean that businesses can't plan, and when businesses can't plan, they freeze. Look, just the other day, I talked to the president of a manufacturing company. They make stainless steel tube valves and fittings. Due to all the tariff uncertainty, he's had to set up a reserve account based on what happens next. All right, well, with that reserve account, that means that that's not money that's going into equipment reinvestment. That's not money that's going into making new hires. What happens when more confidence shatters and markets spiral lower? We may be about to find out. So has the recession, which is a precursor to any depression, already begun? Well, the warning signs are multiplying. Most ominously, at last check, the respected Atlanta Fed tracker is now forecasting a more than 2% contraction in U.S. GDP this quarter. That is quite a drawdown. And 2 negative GDP quarters in a row, I mean, that is the definition of what a technical recession is. And here's a quick history piece for you. In 1930, to try to quell the effects of the Great Depression, tariffs were passed. All right, do you know how badly that turned out back then in 1930? It was called the Smoot-Hawley Tariff Act. It raised tariffs to try to collect more revenue for the government. It didn't work, and the U.S. sunk deeper into the Great Depression with rampant unemployment and poverty and social unrest. There was a rise in crime. There were bank failures, even hunger and malnutrition. That's what a depression looks like right there. Well, back to today. Right now, consumer confidence is collapsing. Retail sales are plunging. The bond market is signaling distress. And yet those in power appear kind of oblivious to the magnitude of the risk. So what if it's not a transition and it is a start of something far worse? And see, this is just part of what's made investors raise their bets on a recession. Stocks are down like a global trade war has begun. Crypto has fallen like risk appetite has collapsed. Bond prices are rising like inflation is declining. And experts have priced in a 52% chance of a recession in the next 12 months. Okay, 52. That's like flipping a coin and just hoping that it lands on good news. Now, in the real estate world, when we talk about direct threats from tariffs, as I've touched on before, the biggest direct threats are tariffs on lumber and on gypsum board. The lumber is used in house framing and trusses. Gypsum board, that just means drywall. The base case for tariffs on Canadian lumber alone, that adds about $10,000 to the cost of a new build typical single-family home, which in turn jacks up all existing housing prices and their replacement cost. But let's look beyond that now at market factors. How is real estate adversely affected if the economy slows, though? Historically, let's look at how recessions really affect housing prices. And this is, again, as I like to say, where we take history over hunches. It's easy to have a hunch about what you think's going to happen, but let's look at what has really happened. How do real estate prices perform during recessions? When we look at the last 8 recessions, okay, and the most current of those was in 2020, and then when we go back 8 recessions ago, that is the 1960s, okay? Well, let me move along in chronological order here. During those 8 recessions, starting in the 1960s, leading up to today, housing prices, and this includes single-family homes up to multifamily apartment buildings, they were, just rounding to the nearest whole number here, up 5% there in the late 60s in that recession, and then up 18%, up 14% in the next recession, and then no change, down 1%, and then up 6%, and then down 13%. That was during the 18-month recession around 2008. And then finally, home prices were up 8% in the latest recession. All right, so in our total of 8 recessions since the 1960s, home prices only fell significantly one time, and they usually rise. That one time they fell, let's explore that. That was during the 2008 global financial crisis, which involved more than just a recession. It was a deep recession. That's why it's called the Great Recession, but it also involved more than that. 2008 was special because that was a time of housing oversupply and low homeowner equity positions and a complete mortgage meltdown backed by flimsy liar loans. Well, today we are in the opposite of all 3 of those conditions. We have a housing undersupply. Americans have a record 300K plus in protective equity that they are not going to walk away from. And mortgage underwriting is stringent, the opposite of a liar loan. So housing prices usually rise in recessions, and if we're teetering on the brink of a recession, there are a lot of reasons to think that housing prices will go up yet again. And by the way, I felt what was happening back in 2008. I invested through it. I think I've let you know before that that's when I owned 2 fourplex buildings, 2008. But it didn't feel that bad to me because my properties were temporarily suppressed in value, and that part didn't feel good, but my rents and rental demand went up because no banks would give loans to borrowers to buy properties, so I wouldn't want to sell when the buildings were paying me a higher than ever monthly income. But let's not lose the greater point. What I'm telling you here, that housing only fell significantly one time through the last 8 recessions, that demonstrates the resilience of the housing market. And by the way, those stats were sourced by the NAR and the NBER, National Bureau of Economic Research. All right, so why is this? Why is housing resilient in the face of a recession? There are a few reasons, but a main one is, see, even if and when times get tough, people still need a place to live and they will pay for it. Especially now when they have record equity. People are motivated to make mortgage payments and make rent payments, or else they're going to be homeless. So tough times are when consumers, they get less likely to pay for their car loan or less likely to pay for student loans. And when they default on credit card payments, that's when this stuff happens. But people will fight like heck to avoid losing their home. I mean, people will pay for food, shelter, and safety. And also, when it comes to recessions, let's not forget how many bad, just god-awful, wrong recession calls there were from over the past 2 to 3 years. I mean, the so-called experts were wrong, wrong, wrong. Today, the economy is actually starting from a good place. And what do I mean here? Today, consumers still have money to spend, and they probably will. This is huge because consumer spending is 70% of the economy. But how will they respond when these higher tariff-induced prices hit more shelves at Walmart and Target? We'll see. Unemployment is still so low that it's practically down there doing squats. But these numbers, they're always backward looking, so it does only aim to get worse. The labor market is firm. Interest rates have been pretty steady. They've fallen a little. Energy prices are still down. So really, the bottom line with what I've shown you so far is that federal policies have induced economic trauma, and it does increase the chance of recession over the next 12 months. During recessions, housing is a top performer, and interest rates usually fall as well. And specifically, interest rates of all types, including the Fed funds rate, mortgage rates, pretty much every interest rate type, they tend to fall in the mid and late stages of a recession. So this is what you can expect based on history, not hunches. But as for a depression, that is super unlikely. We haven't had one in 90 years. And today, I mean, come on. We have seen what the powers that be do. We can see how they respond to crises. They will just print and print and print more dollars to help pave over any problem. And that's not responsible long term, and it creates more inflation, but that's exactly what the government did to pull us out of the Great Recession and to pull us out of the COVID slowdown. We'll review what you've learned today in just a minute, but let me tell you, though you may very well have the majority of your capital smartly invested in real estate, since that's where the long-term wealth creation is, those funds are not very liquid. So what about your liquid funds? Like I pointed out early in the show today, amidst higher inflation expectations, inflation really destroys those in the stock market, and it absolutely crushes savers. Savers really get destroyed because if your bond yield or your savings account pays you 4% interest and there's 5% inflation, That is a 125% hidden tax on your gain. And if that's not damaging enough, there might be tax that you have to pay on that gain, which is not really a gain. This whole thing was a big loss. So for some people, including me, what I do is become a lendlord. Yes, I get a higher yield by lending to others, a lendlord. I mean, why settle for just a, say, 4.5% yield on your liquid funds? I mean, that's the level that both the 10-year bond and the savings account yield today, about 4.5%. I've parked my own liquid funds for a steady 8% yield that I've been getting for years with a long-time established real estate company. I make the loan to them. They have paid on time every time for that steady 8% return. And see, when you understand that directly investing in real estate pays 5 ways and that a 20 to 30% total ROI, therefore, is common and even expected, you can understand how they can pay you and me an 8% return on your liquid funds. You can see where the arbitrage is. Just a little insider tip here. It's called Freedom Family Investments. If you want to learn more, text FAMILY to 66866. Their minimums are pretty low too, $25K, and you don't have to be accredited. So for steady 8% returns from the same place and the same vehicle where I've been getting my 8%, you can just do it right now while it's on your mind. Text the word FAMILY to 66866. Let's review what you've learned today. Americans have higher long-term inflation expectations than they've had since 1993. A 1999 Taco Bell receipt really brings to light how much inflation you have experienced in your life. Though higher inflation can come, hyperinflation is unlikely. Let's not get carried away. The prospects for a recession are 52% in the next 12 months per a plurality of experts, but a depression is really unlikely. Now you know how real estate performs in recessions and why it holds up so well. It even tends to appreciate. Coming up here on the show are some prominent guests, including the leader of Resi Club. You might know about them. Sometimes I share their great charts in our newsletter. Yes, Resi Club's Lance Lambert will be with us. Also, legacy finance expert Laurel Langemeyer will be here with us on another upcoming episode. Thanks for being here, but you weren't here for me. You were here for you. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
You know, whenever you want the best written real estate and finance info, oh, geez. Today's experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.